On Thursday, January 29, 2026, Microsoft investors witnessed something we haven't seen since the 2020 pandemic crash. In a single trading session, the stock plummeted nearly 12%. That is a staggering $400 billion wipeout in market value in just one day. If you just looked at the headlines, you'd be confused. Microsoft didn't report a loss. They reported a massive beat. Today, we're breaking down the Q2 2026 earnings to see why a record-breaking quarter turned into a $400 billion sell-off in just one day. Let's quickly look at the raw numbers versus what Wall Street actually expected. First, let's talk about revenue. Microsoft brought in $81.3 billion, comfortably beating the analyst forecast of $80.23 billion. Next, let's see earnings per share or EPS. They reported 4.14, which was a 5.3% surprise over the 3.93 consensus estimate. By almost any historical standard, beating both the top and bottom lines by those margins results in a stock rally. Even the cloud business was technically a win. Microsoft Cloud revenue crossed the $50 billion milestone for the first time ever, growing 26% year over year. So, if the actuals were higher than the estimates, why did the price crumble down to $430? The answer lies in the quality of the growth and the sheer cost of maintaining it. Wall Street's reaction on Thursday boils down to three specific concerns highlighted in recent reports. The CapEx explosion. This is the number that spooked institutional investors. Microsoft's capital expenditure surged to $37.5 billion this quarter, a massive 66% increase from last year. Analysts had modeled for roughly $34.3 billion. That $3 billion overspend suggests that the AI superfactory is getting more expensive to build than even the experts predicted. Azure grew at 39%. Investors were looking for a much bigger beat. In previous quarters, Azure was the engine that could do no wrong, but growth cooled slightly from 40% to 39%. When you are trading at a premium valuation like $540 a share, meeting expectations isn't enough. You have to crush them. The OpenAI concentration risk. For the first time, we got a glimpse of just how tied Microsoft is to one partner. It was revealed that 45% of Microsoft's $625 billion commercial backlog is tied directly to OpenAI commitments. Analysts from Jefferies noted that this creates a concentration risk. If OpenAI's growth slows or its strategy shifts, nearly half of Microsoft's future contracted revenue could be at risk. One of the most telling moments of the call came from CFO Amy Hood, who admitted that customer demand continues to exceed our available supply. Microsoft literally cannot build data centers fast enough to sell the AI services people want to buy. While that sounds like a good problem to have, it means revenue growth is capped by physical infrastructure, not market interest. Investors hate a ceiling. They see the $37.5 billion in spending and worry that profit margins, which dipped to 68% this quarter, will continue to face pressure as the company races to build more capacity. We are at a crossroads. Is Microsoft a victim of its own high expectations, or is this the $430 entry point of a lifetime? The company is still growing at 17% and printing billions in profit, but the market is now forcing them to prove that every dollar spent on a GPU will return $2 in profit. Are you buying the dip at $430, or are you waiting for the CapEx spending to cool down? Let me know your moves in the comments below. If you found this breakdown helpful, please like the video and subscribe. We will be tracking these numbers quarter by quarter and year by year to see if the AI bet finally pays off. I recently did a deep dive into Elon Musk's path to becoming the world's first trillionaire and that massive IPO breakdown, the one many are calling the next Tesla-level IPO moment. It's the perfect companion to this video if you want to understand where the big money is moving next.